Hey everyone, welcome back to the channel. Today we need to talk about something truly historic that just went down in the silver market. If you're involved in precious metals, you absolutely cannot afford to ignore this. While the West was enjoying a holiday break, with trading desks mostly empty, something incredible was happening over in China. In retail shops across the country, physical silver was being sold for around $91 an ounce. Now, let me be crystal clear. This wasn't some analyst's prediction or a theoretical price. This was real money changing hands for real metal. At the very same time, the COMEX paper silver price, the one you see on your screen, was hovering around $79.59. That's a staggering difference of over $11 per ounce. This isn't just a small premium, it's a massive gap that signals a serious breakdown in how silver is priced. This isn't normal, and it's something the markets will have to deal with now that Western trading is back online. Before we go any further, just a quick reminder, this isn't financial advice. I'm just here to lay out the facts and what they could mean. Your financial decisions are always your own. So what we're seeing is a split market, a tale of two silvers. On one hand, we have physical, in-your-hand silver in China, trading at $91. On the other, we have the paper reference price on COMEX at just under $80. Now, I know what some of you are thinking. What about retail premiums? And yes, retail prices always include costs for making the coins or bars, shipping, and having it available right away. But even when you factor all of that in, a gap this wide tells a much bigger story. It suggests the price for actual delivery is starting to completely ignore the price on the screen. For decades, the futures markets like COMEX have been the ultimate authority. They set the benchmark price that everyone from miners to manufacturers to investors followed. But when you have physical transactions clearing so much higher than the paper price, that authority starts to crumble. The market begins to ask a fundamental question. Which price is the real one? Which one truly reflects supply and demand? And increasingly, the answer seems to be the physical price. Think about it like this. The paper market is a promise for future silver, while the physical market is for silver right here, right now. When people are willing to pay a huge premium for the real thing, it tells you there's a serious disconnect. The paper price is supposed to be linked to the physical metal, but this link appears to be breaking. The contracts are trading at one price, but the underlying asset is trading at another, much higher price. This situation puts the entire pricing mechanism under immense pressure. What happens when industrial users or large investors can't get the physical silver they need at the paper price? They'll be forced to pay whatever the physical market demands. This is how a short squeeze can begin, where those who bet on lower prices are forced to buy back at much higher prices to cover their positions, driving the price up even further. Historically, when we see this kind of split between paper and physical markets, it's a sign that the paper market is losing control. The physical demand becomes so strong that it creates its own pricing reality. We're witnessing a major power shift where the price of the actual metal is starting to dictate terms, not the paper contracts. What does this mean for you? It means the price you see on your screen might not be the price you can actually buy or sell physical silver for. The risk is that the paper market could be forced to reprice dramatically higher to catch up with the physical reality, or we could see a complete breakdown where the two prices go their separate ways. This isn't just about China, it's a global signal. The demand for tangible assets is surging, and the paper derivatives are struggling to keep up. This is a developing story, and it's one of the most important I've seen in the silver market in years. We're in uncharted territory. The established rules of price discovery are being challenged right before our eyes. Pay close attention to this divergence. It could be the spark that ignites a major revaluation in the entire precious metals complex. We'll be tracking this closely, so make sure you're subscribed for updates. Thanks for watching, and I'll see you in the next video. All right, let's talk about what's coming this Monday, what I'm calling the Monday reckoning. We've got this massive unsustainable price gap between the paper markets and the physical markets, and it simply cannot last. When the Western markets open their doors on Monday morning, something has to give. This whole situation is going to resolve, and I see it playing out in one of two ways. First, let's look at scenario A. This is where the paper market finally wakes up and smells the coffee, capitulating to the reality on the ground, the physical reality. What does that look like? It means we could see paper prices gap sharply higher to try and catch up with the intense physical demand we've been witnessing. This wouldn't be a slow, gentle climb. A sudden upward surge would force all those short sellers to scramble and cover their positions. This triggers a cascade of events. Margin calls start ringing, stop-loss orders get hit, and algorithmic trading bots kick into high gear, buying everything in sight. The price doesn't just advance, it explodes. This is what happens when you artificially suppress a price for too long. The release is violent, not gradual. All that pent-up demand is unleashed at once. This kind of explosive repricing is often the direct result of delaying the inevitable. Now, let's consider the flip side, scenario B. In this version of events, the paper market tries to reassert its dominance and control the narrative. Imagine this. Right at the market open, massive sell programs are unleashed. They hit the market with overwhelming force, driving prices sharply lower. The goal here is simple, to discredit the premium we're seeing in the physical market. The headlines would be immediate, screaming that the physical price anomaly was just a temporary glitch or an irrational blip. They want everyone to believe the paper price is the only one that matters. But here's the crucial part. This strategy only works if the physical demand backs down. If buyers in markets like China continue to happily transact near that $91 mark while the paper price is getting hammered down, what happens? The gap doesn't close, it widens. The divergence becomes even more extreme. And this is where the attempt to suppress the price completely backfires. A failed price smash, an attempt to push prices down that does not stick, is often far more bullish in the long run than if they hadn't tried to smash it at all. It shows desperation and a loss of control. It proves the physical market is the true driver. So, what's the bottom line here? No matter which scenario plays out, scenario A or scenario B, one thing is absolutely certain. Volatility is coming. It's unavoidable. For anyone using leverage in their trading, the risks are going to be incredibly high, regardless of what you believe will happen in the long term. This isn't the time for complacency. Leveraged players, both long and short, are walking into a minefield. The pressure that has been building up is about to be released, and the shockwave will be felt across the market. The divergence is at a breaking point. So prepare for a wild ride on Monday. Stay sharp, manage your risk, because the market is about to make a very big move. Thanks for watching, and I'll see you in the next one. Ever wonder why the price you see on a screen for a commodity like silver is different from the price you actually pay? Let's break down why retail pricing is the real indicator of what's happening in the market, and why all eyes should be on China right now. When you look at futures markets, you're seeing a world of leverage, rolling contracts, and what's often called synthetic supply. It's complex, and it doesn't always reflect immediate reality, but the retail market, that's where things get real, fast. It's where physical tightness or a genuine shortage of a material first becomes visible. In retail, there's no kicking the can down the road. Either the metal is available for you to buy at a certain price, or it simply isn't. It's an immediate, settled transaction. Think of it this way. The retail price is the ground floor. When that price starts to rise, it creates a ripple effect that travels all the way back up the supply chain. It puts pressure on the dealers, then the wholesalers, the refiners, and eventually the miners who pull it out of the ground. So, a rising retail price isn't just a small scale event, it's a signal that the entire supply chain is feeling the squeeze. Then there's the psychological aspect, which is just as crucial. Imagine you see silver advertised at, say, $79.59 an ounce. You get excited, you go to buy it, but the actual price you're quoted is $91. What happens? Your confidence in that screen price, the paper reference, starts to crumble. You begin to question which price is the real one. And over time, as more and more people experience this, the transactional price, the price people are actually paying, becomes the new reality. The paper price starts to look like a fantasy. This shift in perception is powerful because it changes behavior and market dynamics from the ground up. Now, let's talk about why China is so important in this equation. China isn't just another retail market, it's the manufacturing heart of the global economy. We're talking about everything from the solar panels on our roofs and the electric vehicles on our roads to the smartphones in our pockets, advanced medical equipment, and even critical defense systems. All of these industries depend heavily on silver. So when the price of silver clears at $91 in China, it's not just retail investors or collectors paying that price. It's procurement managers for massive factories and industrial users who absolutely need that silver to keep their production lines from shutting down. For them, availability is everything. The price is secondary. This is what economists call inelastic demand. It means that even if the price goes up, their need for the material doesn't go down. They have to buy it to stay in business. They'll pay what they must to secure the physical supply. This isn't about speculation, it's about operational necessity. When the world's factory floor is willing to pay a significant premium for a physical commodity, it's a signal that can't be ignored. It tells us that the physical demand is so strong it's breaking away from the paper-traded price. It suggests a fundamental tightness in the market that will eventually be felt by everyone, everywhere. That's why what happens in the retail markets in China isn't just a local story, it's a global economic headline in the making. So the next time you see a gap between the screen price and the real world price, remember what it signifies. It's the retail market showing its strength. It's a psychological shift in motion, and when it's happening in a place like China, it's a powerful indicator of the true state of supply and demand for a critical global commodity. It's the real world asserting itself over the financial markets. Thanks for watching. And if you found this insightful, make sure to like and subscribe for more deep dives into how the economy really works. Have you ever wondered what would happen if everyone holding a claim to a piece of silver suddenly asked for the real thing? It's a fascinating thought experiment that reveals a critical weakness in the global silver market. Let's break it down. Futures markets, like the COMEX for silver, run on two big assumptions. First, that most people trading are just speculating on the price. They don't actually want a truckload of silver bars showing up at their door. Second, everyone has confidence that if they did ask for their silver, it would be there, waiting for them. Think about it like this. The total number of contracts, what we call open interest, often represents many, many times more silver than is actually sitting in the registered vaults ready for delivery. This system works perfectly fine as long as physical demand stays low. It's a game of leverage, a financial balancing act. But what happens when that balance gets tipped? When more and more people start demanding the physical metal instead of just trading the paper contracts, the system starts to feel the strain. Normally, you'd expect something called arbitrage to close the gap between the paper price and the physical price. Arbitrageurs would buy the cheaper paper contract, take delivery, and sell the physical metal for a profit. But in this scenario, arbitrage can actually make things worse. By taking delivery, they drain the already limited supply of deliverable silver, exposing the paper market's bluff and making the shortage even more obvious. This can cause the price gap to widen, not close. Now, let's pivot to the other side of the equation, demand. And for silver, demand isn't just growing. It's becoming incredibly stubborn, or what economists call inelastic. This means that even if the price goes up, demand doesn't really go down. Why? Because silver is a critical component in massive, unstoppable global trends. Take solar energy, for instance. The world is racing to install more solar panels, and guess what? Newer, more efficient solar technologies actually require more silver per panel, not less. Then there's the massive push towards electrification. Electric vehicles use significantly more silver than traditional cars. The charging stations, the power grid upgrades, the next generation batteries, all of it needs silver, and it doesn't stop there. Our modern lives are built on silver. It's in your phone, your computer, the data centers that power the internet, advanced medical equipment, and even critical defense systems. Silver's unique properties make it irreplaceable in these high-tech applications. So we have this runaway demand driven by structural trends that aren't sensitive to price. On the supply side, opening a new silver mine is not a quick fix. It can take a decade or more to find a deposit, get the permits, and build the infrastructure to start pulling ore out of the ground. Demand is accelerating right now, while new supply is a decade away. When demand can't be reduced and supply can't be increased quickly, what happens? Price becomes the only way to ration the available metal. It has to go up until it forces someone, somewhere, to give up their silver. We've already seen glimpses of this. Recently, the physical price of silver in China hit the equivalent of $91 per ounce. That wasn't a paper price. That was the real-world cost to get your hands on the metal. It shows that this rationing mechanism is already kicking in. So we have a paper market built on a fragile assumption of low physical demand, and a real-world demand that is explosive and insensitive to price. When these two realities collide, the fireworks could be spectacular. The question isn't if the paper market's leverage will be tested, but when. And when it is, the price of physical silver might have to do something truly extraordinary to balance the equation. Thanks for watching, and don't forget to like and subscribe for more insights into the markets. Hey everyone, welcome back to the channel. As markets get ready to reopen, all eyes are on silver. We've all seen the headlines about that incredible $91 silver price popping up in China, and it's got everyone asking, what on earth is going on? Is this a fluke, or is it a sign of something much bigger? Today, we're going to break down the key signals you need to watch to understand which way the market is about to break. It's a critical moment, and you need to be prepared. First things first, let's talk about price behavior. Don't get distracted by a brief, flashy price spike. A quick jump followed by an immediate retreat just means volatility. What we're looking for is sustained strength. If the price climbs and then holds those gains or even continues to grind higher, that tells a much more powerful story. It suggests that real underlying demand is absorbing all the available supply at these new higher levels. So rule number one, look for endurance, not just a momentary burst of fireworks. Next up, and this is crucial, are the physical premiums. These are the extra costs you pay over the spot price to get your hands on actual physical metal, like a coin or a bar. If these premiums stay high, even as the spot price rises, it's a massive red flag. It means the demand for the real thing is relentless. People are willing to pay whatever it takes to secure physical silver. If those premiums start to collapse, it might mean the rush is over. But if they remain elevated, it confirms that the physical market is driving the train. This leads us to the big question. How does the gap between the paper price and the physical price close? There are only two ways this can happen. Either the paper market, the one traded on exchanges like COMEX, has to surge upwards to meet the high physical prices we're seeing in places like China, or the physical prices have to come crashing back down to meet the lower paper price. The direction this gap closes will tell you everything you need to know about who's really in control. Does paper rise to meet reality, or does physical retreat back into the shadows? Then you need to watch for signs of inventory stress. This is where the rubber really meets the road. Are we hearing about delivery delays from major dealers? Are some retailers starting to ration sales, limiting how much you can buy at one time? Or even worse, are some sellers suspending sales altogether because they can't source the metal? These aren't just minor inconveniences. They are direct signals that the supply chain is breaking down under the pressure of overwhelming demand. When you can't get the metal, you know the squeeze is on. Finally, consider the overall character of the market. Is it a slow, grinding climb upwards? A steady, relentless march higher suggests that the big players, the ones with deep pockets, are in control and are methodically accumulating. On the other hand, if we see violent price swings and huge daily moves, it points to a conflict. It's a battle between the buyers trying to break the market higher and the shorts desperately trying to push it back down. A grinding market shows control. A volatile one shows a fight for survival. So let's put it all together. That $91 silver price in China wasn't just some random number on a screen. It was a warning shot fired across the bow of the paper markets. For years, the paper price has dictated the physical price. But when physical markets start leading the charge, the paper markets eventually have no choice but to follow. And historically, that transition is never smooth. It's marked by explosive price moves, forced liquidations, and a level of volatility most people have never seen. The silver market is standing at a crossroads. When trading resumes, we're going to get an answer to the question that's been ignored for decades. Which market is the real one? Is it the paper market with its endless derivatives? Or is it the physical market where supply and demand are raw and real? If the physical price holds its ground, the entire power structure of the precious metals world could be flipped on its head. And believe me, when that happens, the repricing won't be subtle. It will be historic. Thanks for watching. Stay sharp out there, and don't forget to like and subscribe for more updates.